The developer's got to ask himself a question. So if I was to take this transaction now to a non-bank lender or a private lender, where they'll essentially allow me to pretty much get started right away, by the time I would have got all of my pre-sales, I could potentially have this project finished and I could start my sell down.
You are listening to the Property Developer Podcast, your home for tips, ideas and inspiration to help take your developing to the next level. Now here's your host, Justin Getty.
Hello and welcome to episode 65 of the show. Thanks for joining me. How are you doing? At the time of this recording, Australia is in a kind of lockdown due to the coronavirus, so life has changed dramatically for many of us in the last few weeks. We're spending more time at home and there's a huge amount of uncertainty floating around. So I hope you're well and coping as best you can. I'll be bringing you some episodes about how you can use this period as an opportunity to set yourself up for growth. So keep an ear out for them in the coming weeks, including a discussion with past guest Byron Sakha about leading through adversity. In the meantime, perhaps you have a bit more time to listen to podcasts, read books and work on those tasks you've been putting off for ages. On the project front, we're in the final stages of our construction funding application, so we should find out this week whether we've been given the final green light to establish our facility. With all the uncertainty around at the moment, it would be good to get that facility in place and move into construction mode. Keeping in mind that completion is some time away and we should be in a different place economically and health-wise, but only time will tell. I've begun requesting abolishment of services in readiness for the demolition, so it's action stations with lots to do. On the other project, we're still in the documentation phase with a view to starting construction later in the year. Before we get to today's guest, don't forget we have the mentoring program available to help you get started in property developing. If you've always wanted to become a developer but don't know where to start or have fears about getting it wrong, then the program is an ideal way to learn the ropes and have someone hold your hand along the way. Email me, justin@propertydeveloperpodcast.com to find out more. Okay, on to today's guest, commercial finance specialist Fabian Demarco from Commercial and Construction Capital. We are talking all things private lending. With the growth in the sector over the past few years, there are many new players in the capital markets, and lots of developers are turning to a source of finance that just a few years ago was more of an exotic species than mainstream. But all that has changed as lending restrictions have kicked in and banks have reduced their exposures and risk appetites. Fabian is a seasoned debt placement specialist with 19 years of experience in property development finance, including land and construction finance through senior debt, mezzanine debt, preferred equity and joint venture funding. Fabian also has experience in funds management, financial markets and retail banking, having held senior roles with well-known banks, hedge funds and money managers. We talk about the pros and cons of private funding, some of the pitfalls to look out for, and when is the best time to use private capital, which may grow even more over the coming years depending on what happens after the coronavirus has passed. So you might be considering this funding avenue for your next project. We haven't had a private capital conversation on the show before, so I was looking forward to hearing about how it can work for you. I started off by asking Fabian what food he would eat until he was sick, and it turns out we share the same love.
Look, I think I'm a sucker for pizza.
Oh yes, that's my go-to as well.
Yeah. I think we're a bit spoiled for choice for good pizza at the moment in Sydney, that's for sure. Seems every second day there's a new pizzeria opening up with traditional stuff. So yeah, definitely pizza, I think.
And what's your go-to toppings?
I like to keep it simple, traditional. I like margarita with eggplant. That's one of my favourites. I think with pizza, it's one of those things that the traditionalists will tell you less is more.
Yes, I remember in my early days just wanting to pile on as many toppings as I could on a pizza.
Yes. No pineapple. Pineapple forbidden.
No, I don't mind a bit of pineapple on pizza. Actually, I had a good pizza on the weekend, so I went down a treat. It's like pulled pork one. It was pretty good.
Yeah. Yeah, you get pretty creative these days.
Now, Fabian, we're here today to talk about commercial and construction capital and private lending. Can you give us a bit of a background on yourself and how you got into the finance game?
Yeah, certainly. So look, my background is primarily financial services. I got into financial services probably around the age of 19, 20. Prior to that, I was an aspiring professional athlete. I used to play soccer at a semi-professional level. Up to about the age of 18, 19, I played with some ex-Socceroos and was doing quite well with it. But once I got to the age of 18, 19, I quickly realised that my focus was more on socialising than it was in putting the hard yards into training. So I quickly realised that I better get myself a new career. And sort of stumbled into finance on the retail lending side of things. I sort of worked my way up through a bit of credit assessment and then eventually into lending and spent a number of years with some of the major banks. And then about six odd years ago, I decided to venture out and start a brokerage. And been doing that and enjoying it ever since.
And then you focused more on the commercial side of things, is that correct?
Yeah, that's right. So about a year ago, I noticed a bit of a gap in the market in the sense that banks were really starting to sort of pull out of that construction and commercial space a little bit. They were getting a lot more stringent with their covenants and their requirements, and a lot of developers were being sort of, I suppose, forced into looking at other alternatives, and private funding was really the only option for these guys. So I decided to actually rebrand and become a specialist broker in the private funding space. So we now only deal with private lenders. We've got relationships with a number of them. We also work very closely with other brokers as well. So we have a broker channel that where we actually work together with brokers in getting these deals placed and settled in that private funding space. So that's pretty much all we concentrate on now. So we make it our business day in, day out to really understand the landscape and terrain of the private space.
And before we get to the private lending sector, what's your view around why the banks pulled back from providing a lot of that commercial capital?
Look, there's probably a number of reasons. I'd say what all sort of kicked it off was a little bit of pressure they started getting from APRA, where a lot of their lending practices were starting to, I suppose, to be looked at. The Royal Commission also shone a light on lending, which also made them sort of reconsider. That coupled with the fact that the property market itself started to sort of take a bit of a downturn, as you sort of will remember from about 12 months ago. So that sort of meant that transactions in the past where maybe they had no hesitation in approving and funding because they knew that property prices were going to continue to sort of rise over the next 12, 24 months. All of a sudden now they're very hesitant and really thinking about whether a project in 12 months' time or 24 months' time is going to end up in trouble, and they're going to end up holding something that they don't want. So they're sort of just becoming a little bit more conservative. They're definitely still lending in that space, but sort of use a bit of an example. That you may find now that a typical banker has 10 deals on their desk, whereas before maybe 7 of those 10 would get funded. Now they probably cherry pick 2 or 3 with the strongest fundamentals, and maybe those 3 get funded, and the rest sort of have to find a new home.
Which leads us to private funding. Or can you give us a bit of a definition, or how would you describe private lending or private capital? How do you describe it?
Yeah, so look, I suppose the main difference between traditional bank lending to private lending is that private lending is essentially funded by private investors in the background. And typically they will invest into a mortgage fund. And then you have a fund manager that sort of lends that money out on behalf of those investors. So where I suppose there's a little bit of a difference between the two is with private, you have a lot more flexibility around the terms. So you can potentially negotiate terms such as the LVR, the rate, uh, pre-sale levels, things like that. Whereas with a bank, they're pretty stringent on their requirements. You either fulfill them or you don't. Whereas with private lending, there's a lot more flexibility. Each deal is sort of a case by case scenario, and depending on sort of how strong fundamentals are about a deal, you can potentially negotiate better terms.
Okay, and so what are the kind of key points that you would look to be negotiating on?
Yeah, so look, I mean, pricing is one thing. The other thing you want to look at is LVRs. So LVRs for those listeners out there, and I'm sorry, I apologize if I use a bit of finance jargon when I talk, but that's your loan to value ratios. So, for example, a bank will traditionally only lend up to 50% against a land development site, for example. So if a developer is buying a development site that's land, they'll typically only lend 50% of that, which means the developer's got to come up with 50% equity themselves, which can be a pretty substantial chunk. In the private space, depending on how strong the sponsor is, how strong the construction project is that's going to follow, you could potentially negotiate that loan to value ratio up to 65%. Now, naturally, that higher risk does come with a slightly higher rate, but it's horses for courses. The developer may find that additional equity that he keeps in his pocket for now can be used to fund his planning or his DA costs. So it may work better for them to pay a slightly higher rate, but it allows them to sort of move the needle along a lot further down the track, a lot quicker.
And I'm interested to know a little bit about the mechanics of how a financier would calculate that risk assessment and then come up with the pricing for the loan.
Look, I don't think there's a specific calculator that they use. So it is a bit horses for courses. So there are a number of factors that can influence the pricing of a commercial or a construction deal. Let's just concentrate on construction for this example. So you've got, the experience of the developer is one. You've got the strength of their balance sheet of that developer. So when I say strength of their balance sheet, for example, if you've got a developer that's building, let's say they're building, a project that's gross realization value of 50 million and they're looking to borrow maybe 30 million, but their balance sheet as in their assets and liabilities on paper shows that they've only got a property worth 500,000. So that's a bit of a red flag, and it's not really adding to the strength of the transaction. If anything, it probably really hurts the transaction. So then you've got also things like the pre-sales level. So how many pre-sales does the project have at the time of the funding approval? So there's a number of different factors that will sort of influence the pricing. Now, the ideal scenario is that a developer is able to demonstrate that they're strong on all those aspects. They've got a healthy balance sheet. They've brought to market 2 or 3 projects similar size in the past. They may have some pre-sales under their belt. And just touching on pre-sales, so one thing that I think it's important that developers maybe think about is sometimes it's not so much about having pre-sales to show that you have debt cover. What a pre-sale does, and not just one, but a few pre-sales do, is that it demonstrates an appetite for the stock in the market. And it sets a bit of a benchmark as well for pricing in terms of value. So when you present a transaction with zero pre-sales, a lender can potentially get a little shy in the sense that there's no demonstrated track record for that stock to be sold. So they have no idea whether the market will receive it, whether it'll move if they need to sell it. Whereas when there's a few pre-sales already underway, it shows that the project's received well by market. There's appetite there, and it sets a bit of a benchmark for the conversation. Now, that being said, there are plenty of funders out there that will consider no pre-sales finance. So again, it's not a be-all and end-all. It's just it helps you tick that box in terms of being able to negotiate sharper pricing. That's all.
Because what do you do in a situation where, and I think this is current at the moment, where off the plan sales are still pretty challenging to get, certainly in Sydney and Melbourne, in my own experience.
Yep.
But there does seem to be healthy demand for completed stock.
Yeah,
people are nervous about buying off the plan for for whatever reasons.
Yeah, so look, I mean that seems to be a common theme as well down or up here in Sydney, and also I'd say in Brisbane as well. So I mean, look, at the end of the day, that probably falls more on the side of the marketing experts than the sales agents. But I mean, I try to put myself always in the position of an investor. If I was looking to buy a property off the plan, I mean, would I personally buy something off the plan right now? I don't know. I'd say what I would do is probably do a little bit more research in the developer in their past projects to make sure that they have brought projects to market on time, on budget, that they've executed. And that should give you comfort around being able to execute on a pre-sale. On the flip side, if I was a developer, they're the sort of things I'd be having my marketing and sales team highlight. That your track record. It's fundamental in sort of gaining trust in the market by being able to present your track record. Now, it's a bit of a catch-22 if you're starting out, but it's quite important if you're sort of trying to move stock and get things sold before you've come out of the ground. But yeah, I'd be highlighting that track record, that you've done it before, that you have delivered to investors, and that things have gone smoothly. That's probably the most fundamental thing.
And what sort of size projects are we talking about here that you would then look to move from bank finance into private finance?
Oh, look, there's no sort of limit. In terms of the private funding market, there's probably about 3 tiers of lending that happens in that private space. And, you've got the first that could be anywhere from 150,000 up to 2 million. And then you've got another group of lenders that'll probably sit in that 2 million to, say, 10 million space. And then you've got another group that sort of won't get out of bed for anything less than 10 million. And they could go up to anywhere to 500 million. So the private space sort of covers a wide variety. Obviously, the larger the transaction, the more due diligence that goes on. But that being said, there's still some pretty able lenders in that larger space as well that can put together some pretty good structures.
And so what sort of projects, or the people that are coming to see you, are they saying, look, we feel like we've got a really strong project, we've got a couple of pre-sales, but we can't get 100% debt cover, we really want to get started and we think we'll make it up along the way and we're looking for an alternative finance source? Is that what you're saying? Yeah,
that's right. So there's probably two typical types of transactions we see. We see the developers that they're purchasing a site, and as I was sort of saying before, they don't really want to put 50% equity into the site up front right now. They sort of acknowledge that they'll probably put some more equity in a bit later on, but at this point, they don't want to put the full 50% in. They also can't demonstrate serviceability. So what serviceability means is that when you fund through a bank, they will typically do a debt servicing on your whole position. So they'll look at all of your debts, all of your expenses, all of your monthly repayments, and they'll make sure that you've got enough income on paper in your tax returns to be able to service that debt. Now, sometimes a developer's income can be quite lumpy. So, 1 year's tax return could be very, very low, if not anything, could even show a loss, when the next year could have large profits, and it gets very difficult to show serviceability with financials like that. So we'll have developers that come to us to say, look, can you just land bank this for us at 60% LVR or 55 or even up to 65? I just want to capitalize the interest for 12 months so that we can do our planning, get our DA, and then exit out into a construction loan. So that's typical of a land bank transaction that we'll see. On the construction side, probably the most common is pre-sales at the moment. So to give you an example, if you were to go to a bank, they're going to give you much sharper pricing. Your setup costs are going to be lower. Your turnaround time for settlement's probably going to be much longer. And more importantly, they're going to really impose that you have close to 100% debt cover in pre-sales before they will draw down your first dollar of construction funding. Now, to get those pre-sales, that could take you 6 to 12 months, especially in a market like this. So, the developer's got to ask himself a question. So if I was to take this transaction now to a non-bank lender or a private lender, where they'll essentially allow me to pretty much get started right away, by the time I would have got all of my pre-sales, I could potentially have this project finished and I could start my sell down. So when you weigh it up like that, the higher pricing that you'll pay on the private space will most likely be subsidized or covered by your speed to market. So bearing in mind the developer, once they draw down on the no pre-sales construction finance, they can essentially start selling off the plan. And what you'll find is with pre-sales, once you're out of the ground, people will probably tend to come and more freely and look to purchase off the plan. Whereas when you're just a vacant land lot with a sign up the front, people are very cautious, investors. But once they see construction actually going, cranes on site, things coming out of the ground, you'll find that pre-sales are probably a lot easier to achieve. So, there's a good chance through the private lending option, the developer may have the full debt cover by the time construction's even completed. So it will just be a matter of then settling all the pre-sales, paying out the facility, and they move on.
And so are you seeing that movement from a land banking facility then rolling over into a construction facility? Is it often with the same lender, or do you tend to find a different product?
Look, there are times where we'll sit with the same lender. There'll be other times where the flexibility of a particular lender on a land bank, but that particular lender may not do construction. However, their pricing and terms for this particular transaction are sharper. So they may look at we may look at two different lenders, one for the land bank, one for the construction. So it depends. It can vary. There's no sort of hard and fast rule. Normally what we try to do, if it's a close, so if the land bank period is only going to be a short period, a 2 to 3 month period where they just need to finalise some things for their DA, we'll always try and place that with the same lender that will do the construction. But if you're talking 12 months of planning DA still, sometimes there is a better option maybe just with a straight out land bank lender, and then we look to move them over.
Listeners, I'm speaking with Fabian Demarco from Commercial and Construction Capital. And Fabian, I've got a question for you about some of the risks that developers need to be aware of when they're dealing with these private capital operators. Obviously, if you're going and talking to a bank, you can feel pretty confident that they're not going to go under or that they're going to pay their bills once you've reached an agreement. Is there a risk when you're dealing with what could be an unknown provider that they'll go bust or that they won't pay their bills on time?
Look, there certainly is risks, and I would be speaking inaccurately if I didn't say that. When I say risks, I suppose the first thing that would come to mind is that the private lending market, and when I say private lending, I'm referring to the commercial side of things, commercial and construction. It's unregulated. So essentially what that means is you've got a group of lenders that really don't have any sort of compliance or regulation that they need to. I mean, there are compliance standards, but in terms of a watchdog or someone that they have to report regularly to and disclose all of their information and how they're transacting, it's highly unregulated. So what that means is the bulk of these lenders do operate to the highest of standards, but there are a number of lenders in this space, which I won't name any if you can ask me to, because I don't want to do that. But there are a number of lenders in this space that some of them are quite, I don't want to say fraudulent, but they can operate within lines, but if you take one step to the right of that line where you shouldn't, whether you know it or not, you'll get clobbered. So, there's things like default interest rates that are applicable that you probably don't hear too much about that in bank land, because if you default in the bank, they'll give you 2 or 3 months to sort of rectify things before anything gets serious. There's some private lenders that, if you miss a payment, for example, if there's a payment that needs to be made and it's missed by 1 day, they will jack your rate up for a month, double, for example, and you'll have to pay that full month of interest at double the interest rate because you missed your payment by 1 day. That being said, there's some lenders that will give you a grace period, that you can talk to them, you can reason with them. So it's highly unregulated, and the best example, which I think I mentioned to you before, is the private lending space. It's kind of like entering into a country that you have no idea how business works there. It's a rough environment. You don't know the landscape. You don't know who you can talk to, who you can't talk to, and as a developer, if you're trying to enter into that marketplace and figure out who's who you should talk to, who you shouldn't talk to, where you can go, where you can't, it's very dangerous, and there's a high chance that you potentially are going to lose some money doing it that way. So we try to act almost like the fixer, if you will, for the developers entering into that terrain. So it's a new environment. We understand the environment. We understand which lenders will suit which projects best. And we act as that conduit, I suppose, because the truth of the matter is I'm not proclaiming that I knew all of this from day one. A lot of this was learnt the hard way over years of experience and building relationships with certain lenders over multiple transactions. So after a while, you begin to understand how a particular lender operates, what their turnaround times are, how do they treat defaults, how do they treat customers, and I suppose over a period of time we've sort of developed our own sort of internal panel of lenders that we sort of grade ourselves, and we know which ones are highly trusted, which ones are a little bit dubious, and which ones to steer clear of.
So the guys that deliver the money in the brown paper bags, they're the ones maybe to be a bit concerned about?
Yeah, I'd say so. Yeah. I could tell you a few stories, but we'll probably leave that for off air.
Yeah, send the builder around. We'll give him cash for his drawdown.
Yeah, that's right. There's a few horror stories there.
And so, are there projects that you wouldn't go to private lending for?
Yeah, I mean, like I said, if there is a developer that, for example, they feel comfortable that they can get pre-sales. That their project's in a very desirable location. It's a boutique apartment block maybe. They're very confident they'll hit their pre-sales in a few months' time. They've got sufficient equity in the deal. They're highly experienced in this type of project. I would definitely be telling that developer, this can fit within a bank. So there's no need for you to pay higher pricing because everything you sort of tick the box on everything. So I guess what I would say to developers, before you even begin looking at your funding options and where you should go, start with the end in mind and sort of see what are the most important things to you. Do you have time to get pre-sales? Is achieving a sharper pricing important to you? What time frame are you working with? Do you have ample time for settlement? Are you in a rush for settlement? So answer all of these questions, and then I'd probably engage a broker or at least someone that's sort of skilled in that area and sort of get their feedback. And then you can make a decision. But private funding for me has always been a solution-based funding model. It's not a mainstream, everyday, typical transaction. That's what the banks are there for, and that's why their pricing reflects that. But if for whatever reason your project or your scenario doesn't fit within a bank's metrics, there are a number of other options now available where previously, there was probably, you could count on two hands how many private lenders were in the market maybe 15 years ago. Now I've got a spreadsheet that's just clocked up close to 200. So as you can imagine, 200 private lenders out there, that there's a good chance that whatever the restrictions are on your project, there's someone amongst there that could probably take it on.
And so do you think that market, the finance market, is going to keep growing, or do you think it'll contract a bit? Do you think the banks are going to start trying to grow their loan books a bit more, or what are you projecting?
Yeah, well, this is the interesting thing. There are a number of private lenders that continue to come into the market. It seems like every second day there's a new one that pops up. And the reason behind that and sort of what's driving this is the return for investors at the moment that would invest typically into these mortgage funds would be anywhere from as low as 6% up to 12, 13% return. I was looking at a study the other day on rental yields on houses as of March 2020, and they're sitting at about 3.5%. So if you've got investors that are hungry for returns, that they know they can invest indirectly into property, into something like a mortgage fund and attract a return of, maybe an average return of 8 to 10% versus 3.5% on a rental yield, it's quite attractive. So there's a lot of appetite out there. So these funds are continuously growing. Where things are potentially going to get interesting is when that investor appetite shifts and all of a sudden they don't want to invest into these mortgage funds. Now, the funds that have access to multiple lines of capital, so they may have access to an institutional line, they may have other investors from overseas or wherever, they'll probably be able to ride that out. But the ones that are heavily reliant on these direct investors, if they turn away and start investing into other assets, then they may struggle to find capital, which will mean you'll see a lot of them leave the market.
And do you think that'll be a reflection on the state of the property market?
Yeah, I think it's all sort of intertwined. At the moment, I mean, look, I don't proclaim to be an economist. I'm not a property expert by any stretch of the imagination. Finance is my thing. But I always look at fundamentals and typical things like interest rates. At the moment, it's quite cheap, relatively speaking, compared to historical times to borrow money. As long as rates remain low, people remain, in a job. You can't imagine why the property market will drop any further or stagnate. I'm a historical guy. I always like to look at long-term sort of trends, and if you look historically, property always sort of appreciates, on average around the 6 to 7% mark year on year. Now that gets lumpy sometimes. You have huge increases in some years, and then some years you'll have stagnant growth or even a drop off, but you average it out, it sort of averages there. I think that everything is still in place at the moment to see steady growth in the property market, which means that the financing side of it should also continue to grow. But that being said, there's a number of things that affect a market and an economy, and the most, I suppose, visual thing at the moment is this coronavirus. So, there's no telling what effect this coronavirus could potentially have on global economies. And when global economies get in trouble, everything sort of just freezes. So I would certainly be keeping a close eye on the market. A mentor once said to me, you're never going to get in trouble by just taking your time. But you're likely to get in trouble if you're always rushing around trying to rush to the next thing. So, at the moment, there's a lot of developers out there that are sort of just, taking their time. They're not rushing into new projects. They're sort of just letting things unfold, which I think is the smart play to do at the moment.
Well, I think as long as we've got population growth and people moving here, that should help to underpin the growth of the property market.
Exactly. Yeah, no, I totally agree. And I can't quote you exact statistics, but I have listened to a few podcasts as well that have had some property experts on there, and they all seem to be saying that the rate of migration and population growth is if anything probably exceeding the supply of new properties into the market, new dwellings. So as long as that continues to happen, you like to think that we'll have a healthy building and construction industry.
Yeah, well, it's certainly not getting any easier to get permits to build places, and it's not getting any cheaper to build property, so you can't sort of see things deteriorating too much unless there's some massive economic shock.
Yeah, well, no, that's right. So time will tell, I guess.
Yeah, which we don't really want, because that's a sign of a much bigger problem.
Yeah, that's right.
So, Fabian, what would be your main tip or advice that you'd give developers out there that are considering their debt options for their next development project?
Yeah, so look, I guess it's a little bit of what I touched on before, and that is before you decide how you want to fund a project, really sit back and look at what are I suppose, the most important aspects to your project. So is timing a critical factor, meaning how soon you're able to get out of the ground? Is pricing. I mean, if you've got a project that is very tight on a profit margin, you may want to run your feasibility through a pricing model of a private funder before you elect to go down that path, because you may find that it doesn't stack up once you run it through the higher pricing. So there's a lot of things that you need to consider. But I would consider, first and foremost, if you can satisfy a bank's criteria and it doesn't hinder your project and you're confident you can do it, then I would try that option first, because obviously it's better for you financially. It's a regulated market. You know the banks. Not to say that you won't have issues with a bank. I'm sure there's plenty of developers that have had issues with a bank, but from a pricing perspective, it's going to be much better for you. However, if there are other factors that influence your decision, then I would definitely then look at alternatives. And the best way to sort of, as I said, is reach out to a broker, someone that you know or someone that you know of, that can give you a little bit of guidance. There's plenty of brokers out there that should be able to give you guidance without charging you anything up front. Then once you've got a bit of guidance and you understand where everything sits, then if you want to move forward, then you can move forward from there.
And what's your thoughts on a specialist broker in this commercial area as opposed to a sort of generalist residential broker who will tell you that they can get commercial finance?
Yeah, I mean, look, I'm all for diversification in a business, and you know, being able to sort of do many things. I guess the reason why I became a specialist in this field is I sort of looked at the medical industry, to be honest, and I gauged it from that, and I realized that if I've got a heart problem, I don't go to my GP. I go to a cardiologist because that's their specialty. That's all they do. Day in, day out, they look at hearts. They operate on hearts. They understand how a heart works. So there's no distraction for them. That's all they do. So if I was going to put my project in the hands of a broker, I want to know that that broker understands that product or that service that they're doing, whether it's private lending, construction lending. That being said, we actually work with a lot of residential brokers that sort of use us as a partner for them to do all of their private commercial and construction stuff. It's horses for courses. I don't want to say to anyone, don't use a standard resi broker, because there are some very good ones out there. I know for a fact, a number of brokers that do everything from home loans to business loans, and they're some of the best commercial and construction writers in the country. So I'm never going to say don't deal with them. But just from my perspective, I just feel that, a specialist is exactly that. They're a specialist. So yeah.
All right. Well, if people want to find out more about you or about your business, where should they head to, Fabian?
Yeah, look, the best way to catch me is probably on LinkedIn. I'm pretty active on LinkedIn, so if you want to just connect with me on LinkedIn, I'm sure you'll put my name in the description. So yeah, LinkedIn, direct message me. Otherwise, you can just catch me by email. All my contact details are on LinkedIn, though. And
your website address is?
Yeah, www.cccapital.org.
Awesome. Well, I know that you do put a lot of good content up on LinkedIn and also on your website explaining different parts of lending. So if people are interested, they can head over there and check out that content and learn a little bit more about the finance side of the game. Yeah, no, definitely. Appreciate that. Well, Fabian, thank you so much for being on the Property Developer Podcast and sharing your knowledge and insight into private lending. It's been really awesome talking to you about it. No worries, Justin. Thank you very much for having me. All right, we'll catch you soon. No worries. Take care. See ya. Bye.
Okay, there you go. An interesting conversation about alternative ways to get your next project funded. It has been challenging getting pre-sales in the past few years, but things were improving until the coronavirus struck and the world has changed again. So now we are back in a tough environment for pre-sales, so private capital may become even more helpful over the coming years. So here's 3 things I took away from my discussion with Fabian. 1. Look to work with private lenders who have a good track record. You want to be sure that you are partnering with a funder that has a good track record on seeing projects through. In the same way that a builder going bust during construction causes major headaches, a lender becoming insolvent or disappearing during construction would also be a massive problem. So make sure they have enough liquidity and experience to complete the project. You need to do your own due diligence on who you may be working with. 2. Determine if your property development project would benefit from private capital. While the funding costs may be higher when using non-bank capital, the higher cost may be offset by speed to market. Instead of waiting around for an extra 12 months to make pre-sales, you could be out of the ground and well on your way to completion, which means you can cash out sooner and work on that next project. So, your velocity of projects could increase through paying higher costs, but your overall return is better as you turn projects over faster. 3. Work with someone who has good experience in non-bank lending. As Fabian said, the non-bank market is largely unregulated, so you're far more exposed if things go wrong. So it would be prudent to work with someone that has experience working with trusted groups and can advise you on the best course to take. Trying to work directly with unknown groups could be a very risky approach. Alright, I hope you enjoyed that finance chat with Fabian Demarco. If you want to hear more construction finance discussions, go back and take a listen to episode 56, where I talk with the guys from Holden Capital about how you can get yourself positioned for a tight lending market. They had this advice for how to be proactive during times of uncertainty.
They're out there constantly talking to everybody in their sector who has an opinion, listening to it and evaluating it. So they're not just sitting back and sort of reading the newspapers. They're actually out there at the grassroots. They're talking to investors, they're talking to buyers, they're talking to agents, valuers, quantity surveyors, builders, and just asking the right questions.
There is plenty of useful tips and advice in that episode, so go back to 56 of the Property Developer Podcast. Okay, don't forget, if you are interested in learning how to develop property, then email me about the Property Developing Mentoring Program that is available to help you get started. It's nothing like a guiding hand to show you the best way when you're starting out. So email Justin at propertydeveloperpodcast.com and I'll send you some further information. You can also catch me on Insta and Facebook for all my latest project pics and videos. You can also post a comment on iTunes if you're enjoying the show. And of course, all the past episodes of the show can be found at www.propertydeveloperpodcast.com. So until next time, may all your projects get funding quickly so you can get started sooner.
You've been listening to the Property Developer Podcast. Tune in next time for more tips, ideas and inspiration to take your developing to the next level. For more developing love, make sure to visit propertydeveloperpodcast.com.